I want to welcome you and thank you for doing this. I'm Bill Alexander. I work at Skadden Arps. I work mostly in the corporate M&A tax area. I'm going to introduce the rest of us in real life, and then we'll go into our roles in this drama. And then we'll let you introduce yourselves. You'll tell us your names, but not where you go to school. And then we'll start running the clock, and it'll be your show. But I'll start with Liz.
Hi, I'm Liz Steve. I'm an associate at Venable in Baltimore in the transactional tax practice.
I'm Bob McKenzie. I'm a partner at Saul Ewing, Arnstein & Lear out of Chicago, and I do only tax controversy.
Now we go into our pretend world. Bob?
I am the CEO of the company,
Okay.
and I will be asking the tax inappropriate questions as we go through this. And can you tell us your team number?
Team number 9.
And we will be your colleagues from your firm, but it's on you. We may try to prompt or steer you a little.
All right, so just to kind of get us kicked off, I'd like to just walk through the circumstances that bring us here. Speak with you, Bob, over at Titan. There are a number of domestic and international transactions that the company wants us to review to see their tax consequences. The first of these is a series of international transactions involving Metis 4 and Metis 5. Metis 4 is a domestic corporation that is providing mainly fiscal assets to Metis 6, a foreign corporation. Metis 5 is a domestic corporation that is primarily transferring non-tangible assets to Metis 6, the foreign corporation. The third transaction dealing with domestic corporations and foreign corporations is the complete liquidation of Metis 3, which is a domestic corporation, to Metis 2, a foreign corporation. We'll start there, and we'll move with the facts as we get along, since we'll get lost if we don't do that.
Okay, I'm going to start talking about the transfer of assets between the domestic and foreign corps. We're told that in the first transaction, the domestic corporation is to transfer certain tangible items, so hard drives, office chairs, leased desks, and inventory in the form of techno-widgets. Normally, this transaction would be non-taxable, but since the transfer is going to a foreign corporation, there is a code section that treats it differently and makes it thus taxable unless an exception applies. So we looked into the exceptions to see if we can still get you the non-recognition treatment. For the exception we came up with was for properties used actively used in a business outside of the United States. And we know right away that the techno-widgets, the hard drives will not be recognized because we're told that they're going to be used in New York City.
So I won't have to pay tax on that?
You don't want to, sir? Sorry?
I said there will be no tax on the techno-widgets, or are you saying there is a tax?
There is going to be a tax. So we're trying to fit you into an exception.
Okay.
Okay, so.
No exception for that.
Okay.
The general rule here, dealing with Code Section 367A3, not to get too much into the weeds of it, is to try to prevent domestic entities from basically transferring the right to future income to foreign entities to avoid taxation. So exceptions are created in the code to allow certain transactions that don't transfer that sort of income. And that's where we're kind of going through the Treasury regulations to try to piece together which one of these transactions meets these requirements.
Yeah, and so the first requirement is to be used actively in a business outside the United States. So I don't think the facts told us exactly where the office chairs and leased desks would be used. Do you have any information about that?
I don't recall what
Bob?
my team, I don't recall
Okay.
what my team.
Okay. Assuming they are used outside the United States with foreign corporation, then there's a couple of additional requirements. They have to be a certain type of eligible property. So the office chairs and the leased desks are still, they can still get the exception treatment, but unfortunately the techno widgets, the inventory, that's not going to be able to get in. So the two possible items that we can get non-recognition treatment for are the office chairs and the leased desks. The office chairs will be non-exempt, will be non-taxable as long as they're used outside the United States. They meet the other requirements. And then as far as the leased desks, if they're the lessors, which is what we're assuming, then the only way that they can get non-tax treatment is if they're currently leasing them to the foreign corporation, and there's no indication that they are. So those will probably be taxable too.
Okay, so I'm sorry, what remains tax-free?
Just the office chairs, under the assumption that they're used outside the United States in an active trade or business.
That's actually a good question for Bob. Do y'all, do you know what the lease structure is right now with those?
I'm the CEO and I'm not down in the weeds and every
Okay.
detail.
We'll follow up with your team on that.
Yeah.
On to the other transaction that's a similar setup. It's just a different domestic subsidiary. They're transferring some intangible items, licenses, trademarks, know-how, and goodwill. And those are actually all expressly prohibited from an exception to the rule that when you send it to a foreign corporation, you're going to pay tax on it. And there's some mechanical sections of the code to tell you how to determine how much income tax to include, but those will be taxable. And we can help your team with that if they need.
Is there any of those 4 items, is there anything I can parse out to avoid taxation?
Not that we know of. We looked, so intangible property is listed as an exempted class within the exception. So basically, you're stuck with the recognition treatment. There was a time where, very recently, a portion of the goodwill, if it was foreign goodwill, that might have been a different story. I'm sorry, they used to have different treatment, but recent IRS rulings have switched that, and now all goodwill is to be treated taxable.
So in my business, it's worldwide to some extent with the websites, and it seems to me that some of that goodwill is international, right?
We've reached out to some peers and colleagues that have worked on similar deals, and they've told us that that is a point of contention at this point, and there might be future litigation in the near future. But as of right now, the IRS's stance is that it's taxable.
When you say it's taxable, it's just the difference between basis and value, or is it taxable in some other way?
There's part of the code, it's taxable in, there's a specific set of rules to determine the taxability, and it's based on how much income would be produced by these items in the future, kind of creating a arm's length transaction. It's almost like a royalty, is that how you would describe it? Yeah.
So it may not be exactly the same as if you just sold it?
No, sorry, yeah, it's not, and there's specific code provisions applying to how to do that calculation. So that's your 2 transactions between the domestic and foreign corporation where they're just transferring assets. And there's a third where you have a domestic corporation of yours is fully liquidating into a foreign parent. And in that case, the base rule is that it's going to be taxable unless an exception applies. So we looked into the exceptions again. And there's an exception for property used in a U.S. trade or business. And the 2 assets that the liquidating company have is a real property interest in Virginia, as well as office chairs, and they're going to be moved to New York City. So the requirements for whether those are taxable or not, to get non-tax treatment, your foreign corp has to use the property within the United States immediately and for 10 years afterwards. And our understanding is that at any point, if they stop using it within those 10 years, you're gonna have to pay tax on the original
At my
transaction.
distribution facility, the real property, what if it becomes obsolete and I have to build a new facility? Does that mean I'm gonna have a taxable event at that point?
I can correct one thing I said. The U.S. real property actually has its own exception for those types of property, and they are not subject to the 10-year window. So the answer to your question is no.
So are you suggesting that the office supplies would have to be used for 10 years?
Yes, precisely.
I
But I'm
mean,
gonna-
like you take
Oh,
reams
sorry.
of paper and
Fair question. Very fair question. I don't think, did we?
It'd be more like used in the ordinary course of business in that case, right?
Okay, yeah, well, we'll check into the status of what happens when something with the useful life of 8 months is used up. But I don't have the answer for that right now, but we can definitely look into that.
And on the real property, is there anything our client should know going forward, having the property in a foreign corporation?
There are some,
Yeah, they do need
yeah, there is some reporting requirements at the time of transfer to the foreign corp. But as far as going forward, I can look into, I don't recall anything specific. Yeah, if there's annual reporting to do, we can definitely double check on that. Okay, so the next item.
Do you all have any further questions?
Go on to the next.
Okay, so the next transaction here, we'll take it stride by stride here, is a proposed transfer of assets from, or a proposed transfer of 70% of the outstanding stock in Titan US to a French corporation called Saturn, and the idea being, or at least what we've been told, is that the transaction will cause the Titan US to become an inverted company. And accordingly, the question that has been posed to us is how is this going to affect your shareholders and your employees, and presumably you as well, Bob, moving forward. What our research shows is that the Treasury regulations associated to Section 7874, the Treasury Department has given us an example that is very close to your set of circumstances in example 20. And essentially how the IRS and the Treasury Department will likely review and view your business is this process will essentially retain its domestic status. So for the shareholders, it will have minimum initial consequence in the transaction. It'll essentially be understood as a Type F domestic reorganization per that example. And moving forward, I mean, you won't get any of the perks of leaving the U.S. jurisdiction. That's kind of the idea behind these statutes, is to avoid giving you the ability to get, the benefits of being a foreign corporation.
Will my officers, shareholders, and I have to pay tax when we do this?
Not initially when you do it, but the way that the stock will be treated in moving forward is the same as how it was treated before. And this is coming off of Treasury Regulation 1.7874-2K2, indicates or appears to indicate that in the transaction that has been demonstrated here, we shouldn't see any immediate effects on the shareholders, but we would see effects on the corporation. We will see effects on potentially future transactions, and that those things might be something that give you caution in pursuing this particular plan and program. Do you have any further questions?
No. Okay. So switching gears a little bit, Titan, you instructed, wants to move into the food distribution business, and
If Amazon can do it, I can.
yes, right, why not? And you've identified a target company called Total Grocery that you'd like to acquire, and you're gonna buy $4.3 billion of their $5.5 billion company, and understood that you're gonna continue the food distribution business using those assets. So we were tasked with whether this plan could be done with no tax being recognized at the time of the transaction. Unfortunately, one of the requirements that we ran into when researching this states basically that if you're going to acquire this company in a tax-free exchange, there's a limited amount of cash, basically a limited amount of anything not specifically voting stock that you're giving. And in your particular case, Titan is essentially sending voting stock, some cash to some dissenting shareholders.
$250 million.
Yeah, okay, so you know that, okay. And the assumption of $700 million of liabilities. So, I don't know how into the math you want to get, but essentially, our math turns out, looks like you're about, what do we have, $490 million off of tax-free treatment. So I don't know what the details of the transaction other than what I just shared with you, but if there's some way to go back to the dissenting shareholders, to go back to Total Grocery regarding their liabilities, that's where I assume the money's gonna have to change.
I think this is the deal, so now you have to figure out a way I don't pay tax, or find a way I can do the deal, because we have the deal together, right? Unless we can structure it some other way.
I mean, what features add up to create this problem?
Okay, so we have the 5.5 billion fair market value of Total Grocery, and we need the fair market value. I mean the value of the assets less their liabilities. So that's $4.8 billion. So that's your denominator in this math problem. The rule to get non-recognition is you need that the voting stock that you're using to purchase must account for at least 80% of the net fair market value of the company you're acquiring. So 80% of the voting stock needs to go to, sorry, I'll back up a tiny bit. The $4.8 billion is your denominator. Your voting stock is the difference between, you're getting $4.3 billion in assets, correct? And in addition to the voting stock, to pay for that, you're paying the $250 million cash, and you're assuming the $700 million in liabilities. So the voting stock is the difference between the $4.3 billion and the $950 million in liabilities. So that's $3.35 billion. That's your numerator in the equation. That turns out to be, so $3.35 billion divided by $4.8 billion, that brings you to like 69.8% is the voting stock that's going into this deal. And like I said, to get the tax-free treatment, under our research, that's the only avenue we found. This was kind of a restriction on it. You need that number to be at 80%, and the difference is the $490 million I just brought up.
Is there another way to do this transaction that might get you there?
Not that we've researched. We spent a lot of time researching. I'm not sure, did you come across any other ideas?
Without, the prerequisite here is you do not want to modify your plan whatsoever, correct?
No, if you have ideas, my point is, we have a deal as to how much
Yeah.
Right.
we have to pay Total Foods.
Okay.
So how do we structure it in some other manner? And we do know that the dissenting shareholders are not going to move. We
They're not gonna
need to
budge.
get rid of them.
Like we said, I mean, the assumption of the liabilities, since that's the lion's share of the 950 million, that's far in excess of 490 million. If there's some way you could work that out with the two parties, but as far as a different avenue for completing the deal, that's the only way that we came across, and there is that roadblock, unfortunately.
At the core of this is figuring out a way to modify any of the variables in the equation. And one way is definitely to modify the variables in that top part of the equation, which is what my colleague is talking about. If there's any way to modify on the bottom as well, that would also change the way that things are going to make it move up into that 80%. But it would require substantial changes to the way you have this deal structured.
Part of the problem is it's just the fair market value of the whole company.
Yeah.
And I don't know how we can.
Well, the
You
portions
can get
are
it
transferred.
re-evaluated for its fair market value, but outside of that, I'm not sure the denominator would change.
But there's no way of sort of making this, changing some other feature that might make this work.
None that we came across. Unfortunately, that's our answer today. We can definitely we can get back on it and get back to you, but at this point, that's where we're at.
If the boot problem was fixed, would we be able to conduct the transaction as structured?
Yes, if the boot problem was fixed. There is a fourth step that involves the subsidiary that ends up with the assets at Total Grocery. They're going to end up moving it to a partnership, and our research shows that the regulations provide that wouldn't affect the taxability of the transaction. It would still be, if you can get the boot problem done, your whole thing works. But without the boot problem, yeah, we don't have a solution.
And how are you going to deal with the canning business?
The canning business is, our understanding is that it's just going to be sent to the shareholders kind of as step one of this transaction. And they're going to be operating it. So, yeah, did you have any plans for the canning business? Or?
We've agreed that we're not taking the canning business.
That's my understanding. Okay.
Long-term business strategy.
I mean, the canning business is really your problem with the boot problem, but yeah.
Is there a way to spin off the canning business and then do the acquisition?
I mean, I'm starting to have some ideas now, but we haven't looked into it. Unfortunately, I think we could get back to you with an answer pretty quick turnaround. What do you think?
Yeah.
You got some time this weekend,
Plenty of time.
but we'll definitely look into that for you.
Oh, I'm sorry. Would there be, I know you said there would be okay to send the acquired business to this partnership. Is there any problem with the distributions coming from the partnership?
The distributions as part of the exchange of the assets going into the partnership and then the equity going back up.
No, the cash distributions in 2020 that are.
Cash distribution. Yeah, so we're, next, yeah. So thanks for bringing that up. We've come to understand there's a planned cash distribution scheduled for 2020 for the partnership. And our understanding is that, is that this one right here?
I can do it.
Okay. We don't think that, so there's a presumption in the code that says since it's so far out, more than 2 years, the planned distribution, that it's not going to be considered a disguised sale is the term, and you don't want it to be a disguised sale.
But we haven't done the transaction yet.
Right, the planned contribution.
Well, so we haven't done
The
the
original
contribution
one.
into Jumbo. So I think maybe what would happen if we distribute the cash in January 2020?
At this point.
If the whole purpose of this is to make sure that the contribution is going to occur in 2020 for the purposes of paying this entire thing, then you're running into the fact and circumstances test that Treasury Regulation 1.707-3 B2 brings up in this type of situation, which can overcome that presumption that my colleague brought up. They're going to look at what happened when y'all decided to plan this out. And there are several different subsections in that area where they say this is things that we look towards. Because the whole point of this rule is to prevent us from coming up with creative ways to avoid taxation on otherwise true sales.
That's what I'm paying you to do.
Exactly. So what we have to do is try our very best to create a transaction that does not run afoul of these very straightforward, clear facts and circumstances they brought up. One of those is determining the transaction of money near the time of the original transaction. The idea being that if that fact is present, they may view that as basically trying to plan out and plan away the transaction so it fits in within a different realm of the tax code. So again, these facts and circumstances are rebuttable, and I don't think that that alone would be the cause, but we run into other things as well, including the burdens or benefits of the ownership of property are shifted through the transaction. It's B2.8 of the Treasury regulation, which essentially looks to see how is the transaction being structured. Is it trying to force the burdens, the negative side, onto one party and allow the partners to have all the benefits of it? Doing that, it looks bad. And that's the plain truth of that. The way that you can structure this, in my eyes, to kind of avoid all of this mess is probably the easiest is to not create a number right now on what you're going to actually distribute to the partners. There's a concept called enterprise risk that they want to make sure that you have. The risk of doing business should not be taken away from the partners of the business. It's the general idea here. And in doing so, and in structuring it now and saying, you know, we're going to have this amount of money that's going to go to the partners and we're going to put it down on paper now, you're eliminating that enterprise risk from the equation and really hurting the chances of this being a non-recognized event. So, you all have any questions about that?
In practice, how would we do that while still ensuring that the owner of the entity gets the cash distribution that presumably it needs to fund its business, other businesses?
As a practical matter, it probably be best, one, not to set the dollar amount now. Avoid doing that. Structuring the partnership in such a way so that you can project into the future that that business should, assuming the economy moves in a way you expect it to, obviously, allow you to make that distribution. That way you keep this enterprise risk in the equation. You're not going to run into the problem of what this is trying to avoid.
Yeah, and I think the easiest thing would just to be have it set more than 2 years in advance. I think as far as easy things we can do. But other than that, yeah, we'd have to look more into it.
I know-
We have 2 more items in a limited amount of time, so is it okay to move on to the class? Okay.
So I'll cover these incredibly quickly since we have a lack of time, but if you have questions, feel free to interrupt. Regarding the insolvency question and subpart F income, I did recently, there's a tax court case that came out, Prestek versus Commissioner, where this became a key issue. If your guarantor is insolvent, is that a factor in whether it's going to go into subpart F income? And the tax court has made it very clear that they do not care the solvency status of the foreign guarantor, at least insofar as they applied the facts of this particular case. I think if you have any opportunity, if you have the stomach for risk, one of the facts in this particular case was that the only evidence they had of insolvency was that their CEO said they were insolvent. So if you have more records, we might be able to persuade someone, but honestly, it would be something that you would have to fight, and there's no real guarantee you would win it. You're running a business, you're not trying to create law school problems. So I wouldn't recommend it in that regard. And regarding the amended tax return, the general rule of thumb is they should have accepted it. You have 3 years to file an amended return. However, they have no obligation to accept it, if that makes any sense.
So 3 years from what date?
It's 3 years from the date of the filing or the due date, whichever one is, in your case, it would be September of 2013, was when you would have the ability for the IRS to make an additional assessment, which is what your desire was for the IRS to make this additional assessment. They would have the ability to make that additional assessment based on Internal Revenue Code section 6501B1, or sorry, wrong Revenue Code section. Yeah, I don't have that one written down right now. I apologize for that. Based on that one I did read, that would make the effective filing date September of 2013. But the IRS has no obligation to accept the amended return and make that additional assessment. There are several court cases where people try to force a refund, and the IRS has no obligation to accept a refund. They've never had one where someone's trying to get an additional assessment. And I would like to ask, why do you want an additional assessment? Because it's kind of an unorthodox approach to avoiding tax debt.
I don't know, I relied on my tax advisors.
Okay. Well, you might want to talk to whoever in accounting wants to have an additional tax assessment. Maybe have them relook over the numbers. Do you have any questions about those last two? I know we were running low on time, so I wanted to bring them up.